There's an old rule among people who study money. Paper promises get canceled. Metal in your hand does not. Right now, in the summer of 2026, that rule is playing out. It's playing out in the largest economy in Asia. And almost nobody outside the finance world is watching it happen. China's central bank has just logged its 20th straight month of gold buying. It added nearly 15 tons in June alone. That was the biggest single monthly purchase in years. It did this during the worst quarterly slide in gold prices in over a decade. Think about that for a second. Because it is not normal behavior. Most buyers panic when a price falls 26% in a matter of months. China's central bank did the opposite. It bought more. So today, I want to walk you through a different question. Not the one everyone else is asking. Not, is this a conspiracy? But why does this keep happening? Why, over and over, throughout history, does a government start treating gold as a strategic asset instead of a speculative one? Because once you understand the pattern, you will never look at a gold price chart the same way again. Let's start with a number that puts everything else in perspective. Gold currently makes up less than 9% of China's foreign exchange reserves. The global average among central banks is 27%. The United States holds gold at roughly 70% of its reserves. Germany is close behind, so China isn't hoarding gold because it already has too much. It's buying because, by its own standard, it has far too little. That gap alone explains a multi-decade appetite. It has nothing to do with any single week's price action. If you were the reserve manager for a country holding $3.4 trillion in foreign reserves, and you wanted to triple your gold share to catch up with the global average, you wouldn't try to do it in a quarter. You'd do it exactly the way the People's Bank of China has been doing it, slow, steady, monthly, buying more aggressively whenever the price dips, month after month after month. 20 consecutive months now, the longest streak since 2015. Now here's where I want to take you somewhere the mainstream coverage rarely goes. History. Because this is not the first time in the last 100 years. A government has quietly built a gold position before, while the public was distracted by paper markets. Let's go back to 1944, to a resort town in New Hampshire called Bretton Woods. After World War II, the major economies of the world agreed to tie their currencies to the US dollar, and the US dollar in turn was tied to gold at a fixed rate of $35 an ounce. For nearly 3 decades, that system held the global economy together. But by the late 1960s, the United States had printed and spent far more dollars than it had gold to back them. Foreign governments started noticing. France, under President Charles de Gaulle, began openly shipping dollars back to the US. They demanded gold in return. By 1971, the pressure became unbearable. President Nixon closed the gold window entirely. He severed the dollar's last link to gold. It's known today as the Nixon shock. It remains one of the most consequential financial decisions of the 20th century. What happened to the gold price after that? It went from $35 an ounce to over $800 by 1980. That's a move of more than 2,000%. The lesson from Bretton Woods isn't about China specifically. It's about what happens whenever paper currency arrangements come under strain. The countries paying closest attention start quietly accumulating the one asset that doesn't depend on anyone else's promise. Fast forward 50 years, and the strain is back. It's just wearing a different costume. Instead of a fixed exchange rate cracking, we have something called de-dollarization. It's a slow, well-documented shift by multiple governments. They're reducing their dependence on the US dollar for trade and reserves. Russia has done it. Several Gulf states have done it in stages. And China, the country with the second largest economy on Earth, has been doing it for years. Gold purchases are one visible piece of a much larger picture. Here's a fact that surprises a lot of people. The European Central Bank confirmed in June 2026 that gold now represents 27% of global official foreign exchange reserves. That overtakes U.S. Treasury holdings, which sit at 22%. That is a historic crossover. For decades, treasuries were the undisputed second reserve asset behind the dollar itself. Now gold has quietly passed them, and almost nobody outside the bond market noticed the moment it happened. So let's bring this back to the everyday investor. I don't want this to just be a story about central banks. I want you to understand what physical gold actually means as an asset class, compared to the paper version most people trade. Here's an analogy I like. Imagine 2 ways to own a house. Option 1, you buy the actual house, you hold the deed. Nobody can foreclose on a promise because there is no promise. There's a physical structure with your name on the title. Option 2, you buy a contract that promises to pay you the value of a house. It's based on a market price managed by a third party. The terms can change if that third party decides they need to change them. Most retail gold trading around the world today looks a lot more like option 2, whether in China, the US, or anywhere else. It's leveraged, it's paper, it's a promise from an exchange or a bank, and that promise is only as strong as the institution backing it, only as strong as the rules that institution is willing to keep in place. Physical gold, sitting in a vault or a central bank reserve, is option 1. No counterparty, no permission required, no rulebook that can be rewritten overnight. And that distinction is exactly why central banks build long-term strategic positions the way they do. When they do it, they almost never use leveraged trading products. They do it through outright allocated ownership. Now, let's talk about India for a moment. India offers a fascinating cultural counterpoint to everything happening in China right now. India is, by some estimates, the largest holder of gold outside of official central bank reserves anywhere on Earth. That's when you count household and temple holdings. Indian families have treated gold as a store of generational wealth for centuries. It's passed down through weddings, festivals, and inheritance, largely immune to the ups and downs of any single trading session. Gold as insurance against currency instability, inflation, and uncertain institutions, held by people who lived through decades of a volatile rupee. What's happening at the state level in China today is the sovereign version of exactly that same instinct. And honestly, it's happening across a growing number of central banks worldwide. It's not new, it's not exotic. It's one of the oldest financial behaviors in human history. Now it's just playing out on a national balance sheet instead of a family's jewelry box. Let's talk supply, because this is the piece almost nobody explains properly, and it matters enormously for where prices go from here. Global gold mine production has been essentially flat for years. It's hovering around 3,500 tons annually, even as demand from central banks, jewelry markets, and technology continues to climb. Unlike a currency, gold cannot simply be issued in greater quantity when demand rises. A central bank can create more currency with a policy decision. It cannot create more gold. New discoveries are getting harder to find. Existing mines are getting deeper and more expensive to operate. Permitting new mining projects can take a decade or longer in most jurisdictions. That structural supply constraint matters a lot right now. The World Gold Council's 2026 survey of reserve managers found something striking. 89% of central banks expect to increase their gold holdings over the next year. A record 45% plan to grow their own reserves specifically. When the buyers with the deepest pockets on the planet are all reaching for a fixed, slow-growing supply of the same asset at the same time, that is not a short-term trading signal. That's a structural setup that plays out over years, not weeks. Now, I do want to be fair here and talk about the volatility, because 2026 has genuinely been a wild year for gold. Pretending otherwise would be dishonest. Gold spiked to an all-time high above $5,600 an ounce in late January. That was driven by a combination of geopolitical anxiety and momentum buying. It then fell hard. It corrected more than 25% by mid-year. The dollar strengthened and speculative positioning unwound. That kind of swing is genuinely dangerous for retail traders using leverage. To be clear, leveraged commodity trading has burned ordinary investors before, in gold, in oil, in nearly every commodity market that offers margin products. But here's the important distinction. That volatility lived almost entirely in the leveraged paper trading layer of the market. The physical layer told a completely different story throughout the exact same period. Central bank purchases, sovereign reserve building, consistent, disciplined, counter-cyclical buying, accelerating specifically when prices dropped. That's the split I want you to hold in your mind. Paper gold had a wild, emotional year. Physical gold had one of its most disciplined accumulation years on record. Those are two different markets, wearing the same name, moving to two very different rhythms. So what does this mean if you're an everyday investor? Watching all of this from outside China, outside the central banking world, just trying to figure out what to do with your own portfolio. First, understand the difference between what you're buying. A leveraged trading product tied to a daily price feed is a different animal, different from a physical ounce sitting in your own possession or in allocated storage. They can move in the same direction over time, but they carry completely different risks. The events of 2026 have made that gap painfully visible, especially for anyone who got caught on the wrong side of a margin call. Second, pay attention to structural demand rather than daily headlines. A 20-month buying streak by the world's second largest economy tells you a lot. It tells you far more than any single day's price swing. Third, remember the historical pattern. Bretton Woods didn't collapse in a week. De-dollarization isn't happening in a month. These are decade-long structural shifts. And gold has been the asset of choice at nearly every major inflection point in that story for the last century. I'm not here to tell you gold is going to $6,000 or $5,000 or any specific number, because nobody honestly knows that, and anyone who tells you they do is selling you something. What I can tell you with real confidence is this. The institutions with the longest time horizons on the planet are central banks with decade-long mandates. They kept buying through a 26% price correction. That is not noise. It deserves your attention, regardless of what happens to the price next week. The story of gold has never really been about a single country, not a single bank, not a single announcement. It's the story of what people, and increasingly what nations, reach for when they stop fully trusting paper promises. That instinct is thousands of years old. Based on what the data shows in 2026, it isn't going anywhere. If you found this useful, subscribe for more breakdowns like this one, breakdowns that connect global monetary policy to what it actually means for your own money. And let me know in the comments, are you watching gold as a long-term structural holding? Or do you see this as just another cycle? I'd genuinely like to know where you land. There is an old rule among people who study money. Paper promises get canceled. Metal in your hand does not. Right now, in the summer of 2026, that rule is playing out. It's playing out in the largest economy in Asia. And almost nobody outside the finance world is watching it happen. China's central bank has just logged its 20th straight month of gold buying. It added nearly 15 tons in June alone. That was the big